Originally, it was optimism around rate cuts. Now it seems like it's optimism around earnings and the strength of the economy. Regardless, markets will find any excuse to rally at the moment. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 9th of April, 2024. And before I get started, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So the few things I wanted to touch on this week, I wanted to start with the US jobs report, which came out last Friday after our market closed, and it came in much stronger than expected. There were more jobs created than expected. There was strong participation. In spite of that, the US unemployment rate unexpectedly fell. Wage growth was still strong, but in line with expectations. It comes after a series of pretty strong data points from the US. There's been strong economic growth. There's been higher than expected inflation. And it really doesn't point to that cooling of the economy, that slowing of the inflation that everyone had assumed we'd see by now. Markets had forecasted 5 US rate cuts this year, and to see rate cuts, we're really going to have to see the US economy slow, and it doesn't seem like that's what we're seeing in the economic data. The economy still looks strong. Now, central bankers, particularly Jerome Powell in the US, have done their part, really sort of trying to help force the market higher by saying, we're ignoring this data, but there's only so long that the market can keep ignoring that data for. And that takes me to tomorrow's CPI reading. If there is another month of higher than expected CPI, I think we might have to see the narrative start to shift. We might have to see central bankers start talking about higher for longer rates. We might have to see less of a pivot than we saw around October, November last year. Keep in mind, when the Fed pivoted around that time, inflation had fallen from extremely high levels, over 9%, to about 4% in the space of 12 months. But they haven't really shifted much since then. So tomorrow's reading is still expected to show inflation well above target. It's still expected to show that inflation isn't really slowing. If it does come in higher than expected, I think we risk a more hawkish pivot from the Fed. So I did want to touch on the yields and interest rates. US government bond yields have pretty much headed back to the levels they were as the Fed pivoted around October, November last year. So these yields did come right down as everyone expected tons of rate cuts, but over the past few months with the stronger data reads, that has pushed the yields right back up. At the moment, US bond market is only pricing in 2 rate cuts this year as the most likely scenario. And like I said, they were pricing in around 5 rate cuts at the start of the year. I do think that we need to be cautious here. In 2021, 2022, the Fed held off suggesting rate cuts or held off becoming hawkish for so long that when they did, markets absolutely tanked. They thought they were doing everyone a favor by being steadfast in their dovish stance, but ultimately it meant when they did have to flip, things were far worse. I don't want to see a repeat of that happening this time around. I think the Fed has been too dovish for the data. Some of them at the very least have been too dovish for the data, and I do think that presents a risk at the May meeting, particularly if tomorrow's data comes in stronger than expected. Regardless though, markets have so far sort of shaken off these stronger data readings. The bond market hasn't, but the equity market certainly has. US markets have ground to fresh all-time highs, although they did come off a bit last week. Our own market is within striking distance of all-time highs. And it seems like the narrative has shifted somewhat from, interest rate cuts, the risk-free rate coming down, towards, strong economy, economic growth, strong company earnings. While that is sort of, ultimately something that should push markets higher, stronger than expected economy, strong company earnings, it really can't justify the current extreme share price valuations. So if you look at the equity risk premium or the additional amount of expected return in shares, you have to be compensated for holding shares because they are inherently risky. That equity risk premium, by most measures, has fallen to its lowest levels since GFC times. And so it does really point to just how overpriced shares are if we don't see interest rate cuts. Alright, finally I did want to touch on iron ore this week. iron ore has actually rebounded quite a bit over the past 2 sessions. It did come off a lot last week, and then at the start of this week it started to bounce back up. That's occurred as the Chinese markets have come out of a holiday period, so they were closed late last week, and it's occurred with a lot of rumors and hopes that there's going to be Chinese stimulus measures to stimulate the steel industry. Their steel industry is struggling at the moment. Steel prices are falling. There's fairly weak steel demand given the issues of the construction sector. And so there's a belief that there's going to be some stimulus in that area, stimulus for the steel producers, and that could help steel prices back up, or at least help the steel producers. So that's triggered a bit of a rebound in the iron ore price, and we can see the 2 red bars on the right hand side of this graph here. In China, red means a gain, and it's pushed it back up towards the peak of March. I do want to caution, however, that no stimulus has really been announced yet, and if it holds this level, it's not going to look super bullish from a technical perspective. Additionally, from a longer term perspective, the dynamics don't look particularly good for iron ore. Chinese iron ore demand should slow from here. It's unlikely that there's many parts of the world that are going to pick up for that lost demand, and there's a lot of iron ore supply coming online, particularly from places like Africa and South America. So I'm not a really strong believer in the longer term dynamics for iron ore. Love a lot of the other base metals, but iron ore, I think it risks going through a period of suppressed prices, in the not too distant future. So let's have a look at the charts for this week, guys. This is the XJO, our market, at least the largest stocks in our market. Really, it basically peaked last week at 7,900. We broke lower late last week. We came down this week to 7,750. For me, that's the key level to watch the downside now. And then we've come up today to some resistance around 78.40. If we break back above 78.40, I suspect we'll head back to the all-time high, 7,900. And if we break below 77.50, I suspect we'll see further selling. First target 7,700 and then 7,600. Overall, I do think there's signs that the current move is starting to top out. We've seen breaks of trend lines. We've seen strong sell days. We've seen increasing odd fundamental justifications for the rallies, and so I do think there's a sign that this momentum is starting to slow. That's also true if we look at the US market. They broke the trend line on the S&P 500. They held below a key resistance level, and they broke below a previous resistance level, which may have acted as support. They are holding around that key level at the moment, 5,200, and so if they do push above it, I'd expect to move back towards 5,260. If we see some further selling from here, my first target would be 5,100 index points. I think it's fairly likely we'll see some selling fairly soon, given the unfettered uptrend that we've seen, and given I think that some negative factors are starting to build up for the market. So that's it for this week, guys. I will end it here. Hopefully you enjoyed. If you did, let us know. If you didn't, keep it to yourself, and we'll see you in the next one.